Hello and welcome to the CNBC-TV18's Mumbai newsroom. I'm Sonal Bhutra and with me as always is Pavitra Parekh and you're watching Mutual Fund Corner. Today we are going to be talking about asset allocation, the key benefits, risks. We'll also discuss investing as per business cycles and what an investor should look at while investing via these strategies, because there's a lot that is happening. So asset allocation, of course, is the key. So we have a lot to discuss and we have a guest lined up as well, Pavitra.
Oh, absolutely. So let's invite her on the show today. This is such a broad topic that, everyone should sort of know about. So we have Salonee Sanghvi joining us. She's founder at My Wealth Guide. Salonee, thanks a lot for joining us and really taking out the time for this show today. Like Sonal was just mentioning, asset allocation is key, right? Irrespective of the kind of asset that you're looking at, the amount you want to invest, you still need to have a strategy in place. So could you just run us through the kind of strategies an investor could consider before they sort of decide how they want to go about asset allocation?
Thank you so much, Sonal and Pavitra, for having me on the show. It's my pleasure to be here. So now, as I think everyone knows, risk and return stems from three elements. One is asset allocation, one is the product and fund selected, and then third is when you invest. Now, 90% of your returns are actually determined by your asset allocation, 5% by the exact fund or company, and 5% by market timing. But unfortunately, we spend maximum amount of time on the latter two and not enough on the first. So it's great that we're talking about this topic today. Every year, a different asset performs better. So it's good to have a mix of different assets in your portfolio. Now, let's look at what are the various ways that one can go about an asset allocation strategy for themselves. The simplest strategy, which is the easiest to use, is 100 minus your age. Personally, I feel this is too simplistic because all you do is you take 100, say if you're 30 years old, you divide 30. So 70% is what you would invest in equity and 30% is what you would invest in debt. Now, I feel it's too simplistic because two 30-year-olds may not necessarily have the same asset allocation or may not need that. So I feel instead that there are two factors that we should look at. First is the risk-taking ability. It's very important to understand and invest basis the risk that you can take. Taking lesser risk will ensure that you're not able to meet your goals. And taking more risk will keep you up at night, which will stress you out. So obviously, over time, risk appetite will change, when you're older versus when you're younger. And also if you have more financial obligations or dependents. The second parameter is the duration that you're going to be investing for or your time to goal. Time reduces the risk and volatility of equity investment. So as the time horizon increases, the ability to take risk also increases. So the idea is to marry time to goal along with risk-taking ability to arrive at an overall asset allocation for your portfolio. Now we can use both of these and come with a allocation matrix. So for example, say if you're investing for less than 3 years, regardless of whatever your risk profile is, whether you're conservative, balanced, or aggressive, you should ideally be invested 100% in debt because 3 years is too short a period for equity to really perform. Now, if you're looking at say a 3 to 5 year period and say you have a conservative risk profile, you can look at 80% in debt and 20% in equity.
Show the previous one.
Similarly, in balanced, you can look at 70% debt and 30% in equity. And if you're aggressive, you can take far more risk, then maybe 60% in debt and 40% in equity. Now, if you're looking at more than a 5-year period, which is actually a good period for an equity investment, again, if you're conservative, then maybe 70% in debt and 30% in equity. If your risk is balanced, then 50-50 in debt and equity each. And if you're aggressive, then maybe a 20% in debt and 80% in equity. So I feel like this is how you can actually look at your asset allocation. Within the equity also, in case if you want to split the equity component up, for any period less than 5 years, I ideally only look at index funds, large cap funds, or flexi cap funds. Anything between 5 to 7 years, you can add mid cap funds regardless of your risk taking ability. And in case if you're more aggressive, you can also look at adding an international fund.
Okay.
over 7 years, you can look at adding a small cap fund if you have a balanced or aggressive risk profile. So
Okay.
we've kind of spoken about asset allocation, but once you've identified and invested basis that, you can't simply just buy and forget. It's important that you evaluate your portfolio and rebalance it, at least once a year, because there will be some years when equity does really well, so the proportion will become really high. And vice versa, where the markets have crashed, equity is not done so well, so your proportion of equity becomes really low. So that's how I think we should kind of ideally look at asset allocation.
Oh, yes, and that is a very comprehensive answer to what we are actually looking at, right? Over periods, considering your age, considering your risk profile as well. So thank you for that. And now we are in a scenario, we are talking about possible headwinds this year. We are saying, okay, maybe global economic outlook is not so great. Nifty may remain range bound. In a time like this, Salonee, what do you think would be the ideal asset allocation strategy that any investor should look at right now?
So Peter Lynch famously said far more money has been lost by investors trying to anticipate corrections than lost in the corrections themselves. Historically, we've seen a lot of geopolitical events, world wars, Gulf War, 9/11, crisis like the pandemic. In the short term, the markets are definitely very volatile and it is difficult to predict how they will react. Like, for example, no one saw the bull run that we had after the COVID-19 pandemic in 2020 and 21. But when you zoom out and take a longer term view, the entire picture changes. So, what I would recommend is instead of trying to time the market basis the news flow that you get, it would be better to kind of stick to your long term asset allocation strategy, basis your risk and your goal.
All right, that point is absolutely well taken. And I mean, this is something I think all of our guests have spoken about, right? When we have them on, that if you're going to try to time the market, it's just not going to work in a majority of the times. And also for mutual funds, at least you should look at a slightly longer time horizon, which in itself cuts out a bunch of the risk. But Salonee, one way that you could approach this is to look at investing in an asset allocation fund itself. What do you see as the key advantages here? And do you think this is something which is perhaps more beneficial for someone who's not too educated in the space, maybe a new investor?
Actually, that's a very good point. Now, obviously, in an ideal world, I would say, follow your asset allocation and do it separately. But in reality, a lot of investors don't follow asset allocation or they don't even know maybe where to start. So for new investors, dynamic asset allocation funds like the balance advantage funds or multi-asset funds are actually a great way. It's a good way for them to dip their toes into investing in equity, getting comfortable with the inherent volatility. Also, many people lack the discipline to, rebalance frequently as per the need, basis their predetermined allocation. So these funds actually rebalance automatically, removing human biases from the equation. So this actually, interestingly, can also be a good option if you, are holding an investment for 3 to 5 years, because you gain equity exposure, you earn higher yields than debt, and you're able to navigate the market volatility. The taxation obviously is an added benefit because you get equity taxation on this. And that also is only incurred when you actually redeem the fund, not each time the fund rebalances. So, there's a definite tax advantage in that sense as well. I feel within the category, I would recommend maybe the Edelweiss Balanced Advantage Fund, which is a trend following fund. It's tracked and rebalanced daily if need be, so which ensures swift action if there is any, if the market corrects, limiting the downside. For example, it fell only 16% in March 2020 versus 30% for the benchmark. And currently it holds about 71% in equity. Another great option is the ICICI Multi-Asset Fund, which includes not only debt and equity, but also has other assets like gold and silver. So they have about 58% in equity, around 9% in gold and silver, and the rest in debt. And it actually generated a CAGR of around 12.5% over a 5-year period versus 11% for the category. So I think these could be some good starters for new investors.
So that actually is very helpful, right? So not only talking to them about a fund, but schemes in that particular fund as well, or the category. So Salonee, say if you want to invest in any fund today, of course you look at the returns it has generated. What are the other points one needs to consider? Because only returns will not be enough, and maybe the number that you're looking at is not the way to look at that number also, right?
That's exactly correct. I feel there are a lot of parameters to analyze funds, but maybe we can look at the top 2 or 3, that would substantially impact what fund you should select. First, of course, as you mentioned, returns is a parameter. But the worst way to pick funds would be to just go look at the past 1 year, 3 year, or 5 year returns and choose. Because every year the top fund is going to vary, and then trying to chase that is only going to increase your taxation and impact your returns. Equity, as we mentioned, is a long-term investment. It's a marathon, it's not a sprint. So I would recommend looking at least at 5 year rolling return over the entire fund history relative to the benchmark. While past returns are not an indicator of future returns, this gives you a good sense of how the fund has performed over different market cycles, like how it's done in a bull market, in a bear market, in a stagnant market. This gives you a good sense of that. Another factor which is equally important is risk. A fund could have performed very well, but the manager may have taken much higher risk to achieve that. So standard deviation is one factor that we can look at to understand how volatile the fund is. Just to give you an example, say there's fund A which has generated 13%, 14%, and 15%, will have the same 3 year return compared to another fund which has, say, 5%, -4%, and +40%. But both have very different levels of risk. So that is another important factor. The third is also, of course, the fund manager. It's important to understand the fund manager style, whether it's growth, value, quality, etc. One red flag is also if there have been too many fund manager exits, because that's definitely not a good sign. And also how dependent a fund is on the fund manager, because we've seen some funds perform quite poorly after a star fund manager leaves the fund. So I feel these are the most important factors to look at, when you're kind of selecting a fund.
All right, Salonee, that is very helpful. And I request you to please stay on for just a minute, because we do have to get into a short break now. But as soon as we come back, we'll get back to this conversation. We have lots more questions lined up.